Per usual, everyone, this channel is for educational purposes only and is not intended as financial advice. It is Macro Monday time. Normally I start off with a James Butterfill of CoinShares flows report. He's slacking today. Don't have a flows report from him just yet, but what I will say is based on my own personal tracking of the US flows, they are down slightly and or just flat. And, if we look at stablecoins, we clearly don't have any mega inflows anywhere, and it's not like interest. This is Google Trends. Interest in Bitcoin worldwide flat, right? So we're sort of at the mercy of market forces if flows are flattened down, and if everybody's still waiting on ETF deadlines. There are a slew of ETF deadlines this week. Probably all get pushed back. Can't imagine any of these get approvals this week, but should they? That's what everybody's sort of banking on. I think everybody has this default bullish mindset based on the assumption that eventually some of these will get approved or all of them will get approved at once, whatever it is. I just think that's a very hard thing to trade. Buy the rumor, sell the news, I guess, in the meantime, because everything else looks so bearish. But there are, 5 or 6 of these deadlines this week. Probably all get pushed back. But hey, I'll be happy if I'm wrong. Looking at meeting probabilities for rates, we've begun to price in another hike here sometime within the next 6 months, let's say. Now, there's no meeting in October. The next meeting is until the end of September. And hey, if markets completely melt down, I think the probabilities will shift away from additional hikes. The unwritten rule of the Fed is financial stability as well as unemployment and inflation. So if the S&P remains bullish towards Q4, a hike is more likely. If we get some sort of mean reversion and then some, a hike will become less likely. Most likely. So I expect things to be bearish in Q3 just across the board, but I don't think that's enough to stop the Fed from hiking in Q4, maybe early Q1 2024. But what's changed from week to week, so this was last week. Last week pre-Jackson Hole, J-Pow and J-Hole, we were pricing in just holding rates. Here, this is going to be the ceiling, essentially, is what the markets were saying, with cuts coming mid-2024, let's say. And now we're pushing cuts back a little bit further, assuming we have a hike, So things have shifted more hawkish, more higher over the next few months. Certainly not good for risk assets, just broadly, right? Another thing that's not good for risk, regardless of rates, is inflation, which has made a higher high here. A new multi-month high on Trueflation, which is a real-time estimate based on a bajillion data points, and they break this down in case you've never seen this before. Between the categories, you can have fun looking at all that stuff. But in the US, at least, for the moment, it looks as though we've bottomed on inflation, and it's going to be interesting where this is going to peak next. Now, hopefully, for the sake of all of us, this holds around 3% or less in perpetuity. But if we start getting CPI prints closer to the 4s, then, we're in deep trouble. The real question I've always had is what happens if inflation keeps rising as the Fed keeps hiking? Eventually something's got to give there, but not a place I don't think anybody wants to be. High inflation and rates going to infinity. Just looking at the Fed's own inflation nowcasting, they've got CPI year over year coming in at 3.83, which would be a significant increase over reported 3.2. And we have that next print on September 13th, which is a week before the meeting on the 20th. So if CPI comes in hot prior to that meeting, I expect these probabilities to shift even more towards a hike sooner rather than later. Unemployment also an important part of that equation, but inflation also very serious business. And just because I've seen this version of this chart 10,000 times, I've even talked about it on this channel, but this is probably the most legitimate version of this chart that isn't a massive chart crime. You've got both axes, right and left, going from -1 to 12%. And we're using the same methodologies, comparing the 70s to now, right? Sure, the idea is there that we may rebound strongly, but it's probably unlikely that we reach that 12% level. In any event, it's probably not over as far as the fight on inflation. Just kind of looking around the horn here where fund flows of going are going. Looking at reverse repo, which hit a new multi-month low here, signaling that this money from reverse repo is filling the treasury market, which is what you want to see if you're on the risk side. You know, we want to see this thing get drained. This is money that's already outside the financial system, essentially. We don't want to see T-bills get purchased with risk money if you're bullish, but you know, that's bound to happen at some point anyway. Year-to-date flows from investors into money markets extremely high globally, almost $1 trillion. So here's your dry powder, the driest of dry powder, just collecting yield on yield on yield, ready and waiting for the go signal to move elsewhere. Probably not happening anytime super soon. And that's because, well, real yields are extremely high. So this just incentivizes everybody. You know, obviously everybody's doing it, right? Everybody's moving money into money market accounts, moving cash into money market accounts, high yield savings, whatever you want to think of that as, out of the market, out of risk assets, and into yield generating vehicles. And if we look at treasury flows, I know some of these graphs are potato. It's funny how everybody just steals graphs from BOA, including me, and then uses them and talks about them. So that's how we get this low quality stuff. But treasury flows continue to remain positive on a multi-week, I think they said like 27 weeks here in a row basis. So a lot of the money is going not to risk, not to crypto, into treasuries, into money markets, that sort of thing. Before I go any further, let me talk about today's video sponsor, Kraken Pro. Kraken Pro is a complete overhaul of the Kraken trading experience with a one-stop shop for advanced and professional traders. Kraken Pro enables efficient trading across multiple markets with a UI that allows for unique optimization tailored to your trading style. You can check out Kraken Pro with the link in the description of this video. And I did notice that they've added iceberg orders. Iceberg are a special type of order that they explain here, where basically you can hide your order size from the market, similar to an iceberg. You know, most of the icebergs below the ice. and you can get fills without funny business, ideally, happening in the order book. Sometimes, you know, you put in a large order or a decently sized order, and you'll see it bounce around in the order book, depending on who else is watching the order book, right? Kind of like a hidden bid, hidden ask type of system. So anyway, additional utility for you on the Kraken Pro side of things. And looking at the dollar relative to Bitcoin, you know, it's been said by many people many different ways, but here's another look at it. If we look at the inverse DXY on the right to Bitcoin on the left, over the past few months, it's been pretty strongly correlated. Those highs and lows almost to the day. So if you're bullish DXY, and if you have a view on DXY, which you should, I would use that into consideration on the crypto side of things. Now I'm super bullish DXY, unfortunately, so that probably means Bitcoin goes lower. But again, if we don't have inflows, if we are completely at the mercy of market forces, exogenous market forces, then you have to pay attention to what is going on elsewhere. And there's been a lot of this like BRICS hype, this death of the dollar hype, and the data just doesn't support that. I mean, this is dollar use for international payments, 46%, euro continues to decline. This isn't, you know, everybody everywhere, but gives you a pretty good idea that the dollar not going anywhere anytime soon. And I think a lot of the BRICS hype was because of just a lot of headlines recently about countries potentially joining BRICS. There was a conference, and yes, if they can get together and make something happen, it would be significant, but we're not there yet. So right now it's just sort of an experiment and a pipe dream. And of course for them, I think the goal would be to get off using the dollar entirely for settlement. We'll see if that happens in our lifetime, but the early stages of that are forming, no doubt. Shout out to Visual Capitalists, by the way. They do the best stuff. I love everything they do. Now, if we look at the dollar relative to S&P, the Qs, oil, I talked about this yesterday, but I don't think it's a coincidence that as bullish as the dollar is getting, we're seeing bearish topping patterns on anything else that's been bullish since the beginning of the year. That includes Bitcoin, obviously. So here's all the patterns to watch, not only, I think, throughout September, but Q3. You know, this stuff could go sideways, it could get angry quickly, it could do a whole bunch of stuff, but none of it in the moment is pointing in a bullish direction. Now, if the dollar turns down below the cloud, back into the channel, if the Qs move higher, oil 82, S&P 4,500, then I think it's game on again for everything, including crypto. But that seems to be the path of most resistance. Max pain, path of least resistance, looks very much to be increasing dollar strength. As maybe terrible based on the data everything is in the US, things are much worse elsewhere. So I would keep that in mind. If we look at, for example, the Trueflation data in the UK, which many people have disagreed with, let's say, they still have a long ways to go to tame inflation on that side of the pond. So that's just a microcosm of what's going on elsewhere. And we've also got, just like Bitcoin, the seasonality argument for the S&P. S&P historically, worst month is September since 1928. So tons of data there. We may not have 100 years of data on the Bitcoin side of things, but we do have 100 years of data on the S&P, and it does not look pretty based on seasonality. And then here's the VIX, the fear index, which, yes, this is a chart crime. This very much reminds me of the inflation chart, but the idea is certainly there. The idea being, look, seasonality for the VIX is bullish, which means fear is rising or volatility is rising in September, typically into Q3, and then we sort of cool off throughout Q4. So the cards and the stars and the horseshoes and the rainbows are certainly aligning for mean reversion across the board for everything. Now, we have had some interesting stuff out of China with will they or won't they ease, will they or won't they stimulate in some way. They had some crazy, reducing taxes by 50% on any investments or something the other day to try to stimulate the markets there. But if we look at global money supply, it's continued to decline. Really, the only slice that's increased has been China. Some in the Eurozone as well, but generally, we're trending lower here. And if we think of crypto, alts, whatever else as a measure of liquidity, it's no surprise that we're sort of muted here. It's maybe more of a miracle that we have popped up at all this year on Bitcoin relative to the declines in the money supply. And there's also been this outcry of data relative to global debt, hard assets, real assets. Now, I think what this graph is arguing is that real assets are undervalued. Commodities, real estate, collectibles, I believe that's what they're arguing here. Undervalued relative to financial assets. And if we look at things like gold and silver on the monthly chart, so this may happen sometime within the next decade, but both continue to look reasonably bullish, holding a reasonably bullish expectation. From what I've seen, commodities, gold have the same problem where if real rates are high, there isn't a lot of impetus to invest in things like gold. So should real rates come down, should recession fears come back, blah, 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 then maybe gold has a chance. But in the moment, it's very much watching paint dry. Same thing with silver, just at levels that need to be broken. And until then, can't get too excited. Looking at global debt, stealing another BOA chart, they're highlighting here that the US debt to GDP in 2000 was half of what it is now. And that's only going to continue to get worse as debt is going to grow and the interest payment on our debt as a share of total revenue is going to continue to grow. And this is the reason why we Bitcoin this stuff right here. The inevitability of the devaluation of the dollar, the destruction of fiat, and the high likelihood that we're going to need to inflate away the debt. Not to get all, doomer on everybody. The last segment here, I'll talk about housing, which I've seen 30 different charts about housing in the past week. I don't know if it's because news has been slow or it's just in the zeitgeist or there was some data point that got released, but show me the incentives and I'll show you the outcome. Show me the disincentives or the penalties and I'll show you the outcome. I don't think it's to anybody's surprise that housing activity is down significantly to record lows as mortgages, housing affordability is at record highs. Okay, this is just one measure of housing affordability. I think what takes people's breath away is the speed at which this has changed. The speed at which we've more than doubled qualifying income for houses, for mortgages, that sort of thing. Certainly pricing out a significant portion of the population. This is mortgage rates, as many people have seen, I'm sure, much higher than 7.31 now. I think probably closer to 7.5, but probably going higher. And at the end of the day, we'll get to this chart. At the end of the day, the people who have a house, who have a mortgage, they don't care. They're paying on average 3.6%. Go ahead, raise rates to 10. They're not going to move, which is what we're seeing, but it's not necessarily going to affect them directly because outstanding mortgages have such a low rate on average, and you're basically getting paid to have a mortgage, right? There's some ARB discussions you can do there. But the idea that high rates affect current homeowners in their mortgage is silly because most people have, a crazy low rate. Same thing with corporate debt. Corporate debt is extremely low. And again, just the affordability dilemma. And it's just not there right now for people. So no surprises that all the housing numbers look tragic. Houses for sale down significantly. Again, not a surprise. The index, MBA purchasing down significantly. And not only that, but in some states like Florida, you're seeing insurance costs rise significantly. So that's not helping the affordability picture either. Then I'll just leave you with this nugget that also went semi-viral about Zillow allowing a 1% down payment program, which typically hasn't ended well. Yes, it may help people get a house, but it may not keep them in that house over time if the economy gets stressed. So we're still watching rates. We're still watching flows. Crypto is just at the whim and the mercy completely of dollar strength. And seasonality is negative for September, so just keep that in mind. That's all I have for this one. Like, dislike, comment, share, subscribe.